2 years ago, PZ Cussons Nigeria had negative equity. In plain English, if the company had been wound up and every asset sold, shareholders would have walked away with nothing because liabilities exceeded everything it owned. Today, EPS is up 413%. Equity has swung from negative 17.3 billion naira to positive 70.6 billion naira. Operating profit has more than quadrupled. Debt has nearly disappeared. That's an extraordinary transformation. But there's one number buried in these results, 38.8 billion naira, that changes how we should read this turnaround. Did PZ Cussons engineer this recovery through stronger operations, or was a big chunk of it handed to the company from outside? By the end of this video, we'll know. Let's go behind the numbers.
Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required.
Today, we break down PZ Cussons Nigeria's unaudited FY2026 results for the year ended May 31st, 2026, with the stock currently trading at 90.00 naira.
Headline numbers look spectacular, but investing isn't about celebrating headlines. It's about asking whether they represent a business genuinely getting stronger or a story that's less sustainable than it looks. Subscribe if you enjoy this kind of breakdown. We cover a different Nigerian-listed company every reporting season. Let's start with the business.
PZ Cussons Nigeria manufactures and distributes well-known consumer brands, soaps, detergents, personal care, baby products, sold through distributors, wholesalers, and retailers. Like any fast-moving consumer goods business, its profitability depends on the purchasing power of consumer, manufacturing and distribution cost control, exchange rate movements on imported raw materials, and pricing power in a competitive market. This context matters because this isn't the story of a company that has consistently been strong. It is that of a company recovering from several very difficult years. So the first question is the business actually improving? We'll start with the most obvious place, sales. Revenue increased from 212.63 billion naira in 2025 to 260.46 billion naira in 2026. That is a percentage growth of 22%, a genuinely encouraging number in Nigeria's tough economic environment. It tells us PZ sold more, not just survived. But revenue alone doesn't tell us if the company became more profitable. For that, we need to look deeper. Notice what happens as we move down the income statement. Revenue grew by 22%. Gross profit grew a little faster at 27%. Then suddenly, operating profit jumps by more than 300%. Profit before tax grows even faster. And profit after tax finishes nearly 4 times higher than last year. That's not the normal pattern you'd expect from a business whose sales grew by just over 20%. Normally, profits move broadly in line with revenue unless something significant changes inside the business. And that's exactly the question these numbers raise. How did profit grow nearly 400% when sales grew only 22%? Did management suddenly become dramatically more efficient? Did the business enjoy stronger pricing power? Or were there other factors working behind the scenes? Because before we decide whether PZ has become a stronger investment, we first need to understand what actually drove this extraordinary profit growth. The answer usually lies somewhere between the top and bottom of the income statement, the margin. This tells us how much profit the company keeps from every naira of sales after different layers of costs have been deducted. The higher the margin, the more efficiently the business is turning revenue into profit. Gross margin improved from 27.1% to 28.1%. It means PZ kept slightly more profit from each product it sold than it did a year earlier. Cost of sales grew more slowly than revenue, suggesting better pricing, improved manufacturing efficiency, a more profitable product mix, or some combination of all three. That's exactly the kind of improvement investors like to see because it comes from the core business. But then something much bigger happens. Operating margin nearly quadrupled. That's too big to come from the core business alone. Something else must have boosted profitability. Here we find the missing pieces. Foreign exchange gains and other income together contribute over 51 billion naira. That is an enormous number. and it changes how we interpret the headline profit growth. This doesn't make the profit fake. Gross profit and gross margin genuinely improved. That's real operational progress. But a large slice of the bottom line came from items outside the core business that may likely not repeat. So smart investors often ask, how much of this profit is likely to show up again next year? For PZ, the answer is somewhere in the middle. The operational recovery looks genuine, but the headline earnings also benefited from factors that may not recur every year. So if we're trying to judge whether this turnaround can continue, a little caution is still warranted. Which brings us to the next and perhaps even more important question. If reported profits were this strong, did the business actually generate the cash to support them?
Here's what we find. PZ reported profit after tax of 49.10 billion naira. Operating cash flow came in at 26.06 billion naira.
In other words, the business generated real cash, but not as much as its accounting profit would suggest. Should that worry investors? Not necessarily. Cash flow and accounting profit rarely move in perfect lockstep because working capital can temporarily absorb or release cash during the year. Customers may take longer to pay. Inventory levels may increase. Suppliers may be paid earlier. All of those affect cash flow without necessarily changing reported profit. So while cash conversion lagged earnings this year, there's nothing here that suggests the reported turnaround is simply an accounting illusion. In fact, the cash flow statement contains another encouraging clue.
That large negative financing cash flow might look alarming at first, but it's actually healthy. It means PZ is aggressively paying down its debt instead of using its improved financial position to borrow more. That's a decision that strengthens the business rather than increasing financial risk. At this point, we've answered two of the biggest questions investors ask. Has the business improved? Yes. Can we reasonably trust that improvement? Again, yes, with some caution around the sustainability of certain income items. Which brings us to the next question. If the turnaround is real, did existing shareholders actually benefit from it? That's where earnings per share, or EPS, comes in. EPS tells you how large your slice of that pie is for every share you own. EPS increased from 2 naira 30 kobo to 11 naira 80 kobo. That's a remarkable 413% increase in just 1 year. But there's another detail that's just as important, and it's easy to overlook. The number of shares in issue didn't change. Why does that matter? Because companies sometimes boost profits while issuing millions of new shares to raise capital. When that happens, existing shareholders own a smaller percentage of the business, so the benefit of higher profits gets spread across more shares. This is called dilution. That didn't happen here. PZ generated this improvement without diluting existing shareholders. Every bit of that increase in earnings per share accrued to the people who already owned the business. That's exactly what long-term investors want to see. One important caveat remains. While EPS growth was real, part of this year's earnings came from foreign exchange gains and other non-recurring income. Future EPS growth will depend on whether management can keep improving the core business without relying on those one-off gains. Shareholders clearly benefited this year, but sustaining that value creation is the real test. There's one other area where that future will become visible. Dividends. No dividend was declared for this financial year. After several difficult years, that's understandable. Management appears to be prioritizing financial stability over immediate shareholder distributions. For income investors, that may be disappointing. But for long-term investors, it can actually be a sensible decision. A company that restores its balance sheet first is usually in a much stronger position to pay sustainable dividends later than one that resumes distributions too early. The next important question is, what did management do with this stronger financial position? These numbers tell an extraordinary story. Borrowings collapsed from 71.3 billion naira to 5.9 billion naira. Equity swung from negative 17.3 billion naira to positive 70.6 billion naira.
one of the most dramatic balance sheet reversals on the NGX.
On the surface, this looks like management executed one of the strongest financial recoveries on the Nigerian Exchange. But we've been asking throughout this video, how much of this turnaround was earned through operations, and how much came from somewhere else? Here's the answer. A 38.81 billion naira capital contribution and debt waiver provided by PZ Cussons' parent company. The parent company forgave a substantial amount of debt and injected additional capital into the Nigerian business. That single action played a major role in transforming the balance sheet.
Does that make the recovery less real? No. The debt reduction and stronger equity are real. But it means this wasn't a fully self-funded turnaround. Parent support repaired yesterday's balance sheet. Only strong operations can sustain tomorrow's profits. Overall, I think management deserves considerable credit. They improved profitability, avoided shareholder dilution, generated meaningful operating cash, and aggressively reduced borrowings instead of allowing debt to linger. At the same time, it's only fair to acknowledge that part of this recovery was made possible by the parent company's intervention. So the strongest conclusion isn't that management performed miracles. It's that management successfully combined operational improvements with strategic parent company support to put PZ back on much firmer financial ground.
Now, only one question remains. Has the market already priced in this recovery? Let's start with the most useful valuation measure for this type of business. The price-to-earnings ratio, or PE. At today's share price of 90 naira, investors are paying about 7.63 times this year's earnings. The stock doesn't look expensive for a company with 22% revenue growth, dramatically lower debt, and 400% plus EPS growth.
PV/NAV at 5.6x times looks steep, but for an FMCG company, book value barely captures the real value. PE is the better guide here. So based on earnings, a fair value range of roughly 70 naira to 95 naira per share is estimated. At 90 naira, this places PZ near the upper end of its estimated fair value range, but still within it, making it reasonably valued. Investors aren't buying a distressed turnaround anymore. They're buying a company starting to prove it.
The next chapter of the story. What could change the investment case? It could be more bullish if core operating profit grows without leaning on other income, cash flow converges with earnings, dividends resume and are well covered, margins hold steady, debt stays low. Or more cautious if earnings increasingly depend on FX gains or one-offs, cash conversion weakens, borrowings creep back up, gross margins reverse.
If you remember just one thing from this analysis, make it this. PZ Cussons has largely completed its balance sheet turnaround. The next challenge isn't repairing the business. It's proving that future growth can be driven by stronger operations rather than exceptional gains or parent company support. For investors with a long-term horizon, I'd classify PZ Cussons as an accumulate, because the business itself appears fundamentally healthier than it was just a couple of years ago.
That's PZ Cussons FY2026 results, broken down. If this helps you become a more informed investor, subscribe. We publish a new breakdown every reporting season, focused on what really matters. Has PZ Cussons done enough to convince you this turnaround is sustainable? Or is the market giving too much credit to the parent company's support? Let me know in the comments. Until next time, this is Behind the Numbers TV. Thanks for watching.